Imagine two companies, each worth billions, suddenly announcing a merger. Headlines flash across the news, analysts debate the rationale, and investors scramble to react. On the surface, it may seem like a straightforward business move, a merger of equals, or a strategic alignment to dominate a market. But behind every billion-dollar merger lies a web of secret deals, negotiations, and strategies that rarely see the light of day. These are high-stakes transactions where lawyers, bankers, and executives maneuver behind closed doors, shaping industries and fortunes before the public ever hears a word. The story of a merger is often far more dramatic, calculated, and intricate than the press releases suggest. The process usually begins quietly, often months or years before any announcement. Companies identify potential partners that can complement their strengths, fill gaps, or eliminate competition. This isn't just a financial decision, it's a strategic one. The executives involved conduct private research, study market dynamics, and even hire intelligence teams to analyze every aspect of a potential partner: finances, management, product lines, and vulnerabilities. Early discussions are discreet, often conducted under the cover of non-disclosure agreements. These preliminary moves set the stage for billion-dollar decisions that can redefine industries. Negotiations themselves are rarely straightforward. Behind closed doors, teams of lawyers, financial advisors, and investment bankers are constantly recalibrating terms to maximize value. The price of a merger is rarely just a matter of current valuation. It's tied to projected growth, potential synergies, and even tax considerations. Sometimes, these negotiations involve complex arrangements like stock swaps, earnouts, or debt restructuring that are invisible to outsiders. The public only sees the final numbers, but the true deal involves layers of strategy, risk management, and contingency planning designed to benefit key stakeholders. Confidentiality is key. Executives and advisors go to great lengths to keep discussions secret. Rumors of a merger leaking too early can affect stock prices, alert competitors, or disrupt markets. That's why most major deals involve quiet communications, shell companies, or preliminary letters of intent that hide the real negotiations. Even employees of the companies involved may remain unaware until the deal is finalized. These secrecy measures are not just about surprise, they're about control. Controlling information gives executives leverage and prevents market forces from derailing the deal before it's fully structured. Financial engineering is another hidden component. Private financial arrangements, hidden liabilities, and special investment vehicles are often part of mergers. Companies may restructure debt, move assets, or create subsidiaries to optimize tax outcomes or minimize risk exposure. Hedge funds, private equity firms, and institutional investors are often consulted or quietly involved, each seeking to protect their positions or extract additional value. These financial maneuvers are complex, and the public rarely sees how they shape the eventual merger terms, valuation, or profit distribution. The human element is also crucial. Billion-dollar mergers aren't just numbers on a spreadsheet, they involve egos, rivalries, and strategic power plays. CEOs and board members negotiate not just for financial gain, but for control, influence, and legacy. Leadership transitions, key personnel retention, and corporate culture alignment are often secretly negotiated. The way top executives are incentivized can determine the success of the merger long after it's finalized. Sometimes, side agreements determine who runs the merged entity, who gets bonuses, or how decision-making authority will be divided, details that the public never learns. Regulatory considerations add another layer of secrecy. Antitrust laws, industry regulations, and international trade rules can influence how a merger is structured. Companies may preemptively adjust operations, divest certain units, or structure deals in jurisdictions favorable to approval. Legal teams often work months ahead, anticipating potential regulatory challenges and negotiating remedies quietly with authorities. These behind-the-scenes strategies can make or break a merger, yet the public sees only a sanitized, legalistic explanation of the process. Timing is everything in billion-dollar deals. Market conditions, competitor moves, and investor sentiment all play roles in when a merger is announced. Executives and advisors monitor the environment carefully, often delaying announcements until conditions are optimal. A poorly timed reveal can reduce shareholder value, attract unwanted scrutiny, or embolden competitors. The public rarely appreciates the months or sometimes years of strategic planning that precede a merger's announcement, or how critical timing can be to maximizing returns. Confidential side deals often accompany mergers. Strategic partnerships, licensing agreements, or prearranged contracts may be negotiated in parallel to the main deal. These arrangements can enhance profitability, secure key resources, or lock in future growth. For example, a company may quietly secure supply agreements with essential vendors or lock in contracts with government entities before the merger is public. These side deals are often decisive in creating value but remain completely hidden from public scrutiny. Investment banks and advisors play a pivotal, secretive role. They structure financing, advise on valuation, and sometimes act as intermediaries to facilitate the deal without revealing intentions. They often negotiate fees, performance bonuses, or contingent payments tied to the deal's success. These financial advisors are part of a high-stakes game where knowledge is power and every strategic decision can shift billions in value. While the public sees a merger as a single announcement, the advisors behind the scenes are managing an intricate dance of risk, leverage, and negotiation. Even after a merger is announced, secrecy remains essential. Integration planning, employee retention strategies, and operational consolidation often continue quietly for months or years. Companies work behind the scenes to align systems, restructure teams, and extract synergies without creating market panic or employee unrest. The public sees only high-level statements about synergies or strategic alignment, but these phrases mask years of careful planning and delicate negotiation that determine whether the merger will succeed or fail. Market reaction is another carefully managed element. Executives often coordinate investor presentations, press releases, and media interviews to shape perception and maintain confidence. Analysts are briefed selectively, and guidance is provided in a way that supports stock price stability. Controlling the narrative ensures that the public sees the merger as positive, while insiders continue to manage the operational, financial, and strategic complexities behind the scenes. Managing perception is as important as structuring the deal itself. Sometimes, mergers involve defensive strategies that the public never learns about. Companies may acquire partners to prevent a competitor from gaining an advantage, or they may structure deals to limit hostile takeovers. Legal maneuvers, poison pills, and shareholder agreements can be crafted in secret to protect value. These defensive tactics are often crucial to the deal's success, but remain invisible to outsiders. Behind every merger announcement, there's often a silent battle for control and strategic advantage that shapes the terms and outcomes. The complexity of billion-dollar mergers also allows for selective disclosure. Companies may release only the information required by law while keeping other strategic details private. Revenue projections, operational plans, and synergy estimates may be discussed internally but never shared publicly. This selective disclosure preserves competitive advantage, allowing the merged company to act decisively while competitors remain in the dark. For investors, this means that the public record rarely tells the full story of how value is created. Cultural integration is another hidden challenge. Merging two companies is not just about finances, it's about people, processes, and corporate identity. Behind the scenes, teams work to align values, retain top talent, and manage internal conflicts. Secret plans for leadership structure, office consolidation, and operational standardization often determine whether a merger succeeds long-term. The public rarely hears about these cultural negotiations, yet they can make the difference between a profitable merger and one that falters. Tax strategies are often a silent but critical component. Companies may structure mergers to optimize tax liabilities, move assets to favorable jurisdictions, or take advantage of international treaties. These moves can save billions or enhance shareholder value, but are rarely disclosed in detail. Tax planning in mergers is highly technical and conducted behind the scenes, further highlighting the secretive nature of billion-dollar deals. In many cases, the real value of a merger is unlocked years after the announcement. Revenue synergies, operational efficiencies, and strategic positioning may take time to materialize. Executives, advisors, and key investors often have exit strategies or long-term plans tied to these outcomes. While the public sees only quarterly earnings and press statements, insiders are executing detailed plans that determine whether the merger delivers its promised billion-dollar value. Patience, planning, and secrecy are all part of the formula for success. For viewers, the lesson is clear. What you see in headlines is only a fraction of the story. Behind every merger announcement are months or years of secret negotiations, side deals, strategic planning, and calculated risk-taking. The billion-dollar price tag reflects not just market value, but the intricate, carefully orchestrated work that happens behind closed doors. These deals shape industries, create fortunes, and sometimes change the balance of global markets, all while remaining largely invisible to outsiders. The story of billion-dollar mergers is a story of secrecy, strategy, and execution. It's about understanding that every public announcement hides a complex web of decisions, negotiations, and planning that determine ultimate success. It's about the power of information, timing, and human negotiation to create massive value. The next time you see a merger headline, remember that behind the public words, a highly orchestrated, secret world is at work, one that determines who wins, who loses, and who profits on a scale most of us can only imagine.